All right, market patterns. Patterns. Patterns come in all shapes and sizes, and if you've been around long enough, you begin to identify them very quickly. They take form in many different shapes and names: triangles, wedges, pennants, flags, bull, bear, etc. They happen in all time frames, and like everything else, the patterns that happen on the higher time frames tend to be significant, and we should be aware of them and their current and future impact on the markets we trade. So why they happen. Patterns develop because of underlying buying-selling pressure in a stock, usually from a reduction in volatility, but for many different reasons. Right? Potential profit-taking, new news, good or bad, equilibrium in buyers and sellers before a trend continues / reverses, etc. Therefore, context surrounding the pattern is almost more important than the pattern itself. If you understand where we are in the cycle and understand how the stock has been trading up to that point, then you can use that pattern to your advantage. We can gain a great deal of information from how the pattern plays out as well, trend strength / weakness. Right, so I remember in the beginning, starting out, right? People would sell you on the idea that you could make a profitable trading strategy just out of using patterns. It's a triangle, there we go. When it breaks out to the upside, you buy it. When it breaks out to the downside, you sell it. Well, we can already see a lot of issues with that. Well, what happened beforehand? Where's the larger trade? Where's the larger trend at? Does it look like the market's already been running for a long time? Where's it at in the cycle, right? Has it been running for a long time? Does it look tired? What about how it breaks out of that pattern, right? Where do we sell at? Where do we buy it? Where do we make money? Where do we take profit, right? So many things are missing from that. And again, it's just very, very short-sighted. All right, so some examples, just really quick. You guys have probably already seen this stuff before, but why not just throw it in there, right? So here's a wedge pattern, also known as a bull flag, kind of, if it was a little more, these lines were a little more parallel, you get kind of the same idea though. Breaks up here, right? See? And so we talk about the context that happens beforehand, right? In my opinion, the strength of the trend is going to show its hand once we've gone through some sort of consolidation pattern. So here on this bull flag and this wedge, right? These were buyers that were loading up and buying this on discount, right? So when we broke out of here, we barely made a new high before we started another pattern. This is a sign of weakness. This is not a sign of strength, right? We should see continued price movement out there. That would show that it was a strong trend. So that would already make me nervous about this pattern itself. And we kind of see how that plays out, right? Again, consolidation should be a strong move, whatever happens out of here, whether it's the upside or the downside. We come here, test the highs, and then, right back down to the consolidation here before it breaks lower, right? So we see that ultimately the trend worked out, and we can't see in the future, so we don't know that this actually happened. But again, the fact that these patterns happened near each other, near the highs, that's context, right? It's things that we can be paying attention to and be monitoring. But again, so real quick, so just a triangle, right? Consolidation. Most of these are consolidation patterns. Here's another bull flag. You call it a bit bigger, but again, very, very weak on the back end. But it showed that it was consistent. And that this is obviously, we can tell that this is a longer term trend, right? And ultimately it played out to the upside and it worked out once it got through this digestion. It worked out. So, limitations and advantages. Remember that the pattern itself is not important, but the information that is relayed as the pattern plays out is what is critical. It's so easy to fall into the trap of playing the market predictor, which is gambling, and most of the time ends in losses and frustration, right? We all get lucky, but the long term plays out. We do not take trades based off some random market pattern and isolation of other information. That is not the point, nor a successful long-term strategy. Our main objective is to be able to read the stock as best as possible, let the price action lead us, and then take advantage of what it is telling us. The better you learn to read the stock, the more money you will make. Patterns are just a piece of the puzzle.